Thank you, David. Always, it's really a great pleasure to be here, actually. It's my first time with you guys. I hope many more to come. What I'm going to teach you today, it's going to be a training session. Please do get pen and paper out, or however you take notes, because I'm going to give you a lot of information today. We're going to talk about what I call the 3 master keys of trading, the essential guidelines for stocks and options traders. That's my speciality, stocks and options. Now, before I get into the actual slide deck, it just struck me, you might not know who the heck I am. So I'm not going to go into a big spiel about it, but I've been around in the industry for quite a long time. I serve for retail investors like you guys with trading solutions that make things easy, but are based on proprietary and proven techniques and portfolio analysis as well. So what we do, as you'll discover, is based in logic. We don't do any hocus pocus or magical numbers. And I've got a very big body of work out there with 2 best-selling books and others as well that you can find on Amazon. So you want to find something out about me, you can go ahead and do that. Now, I'm just going to get on with this because it's, in the short space of time that we have, got a lot of information to disseminate to you. And what I'm actually going to reveal today is exactly how we do what we do. And again, it's encompassed in what we call the 3 master keys of trading. So let's move on. Here is the Wise Trader System. The Wise Trader System is an organization which is dedicated to producing trading systems which offer discretionary retail private investors and traders like you guys. And it goes like this. There are 3 master keys. First of all, market timing. Now, market timing is a bit of a holy grail for traders. It's a thing that everyone wants to get right. And in terms of automation, it's extremely difficult to do. But if you can be at least not on the wrong side of the market, that is going to stand you in very good stead. Give me a wave if that makes sense, by the way, not being on the wrong side of the market. So for example, imagine the market's just gone parabolic. You don't want to be buying here because it's overbought. Don't be on the wrong side of the market. So there are several keys that we look at to make life very easy to go into market conditions where the probabilities at least will either favor us or not be against us. So market timing, I'm going to go into that into quite some length today because not many people talk about market timing. Most people rely on conspiracy theories. Most people rely on guesswork or even looking at what happened in the past. How many times have you guys seen? Go on Twitter, you can see it all the time. But people going, this is exactly what the cycle will do because it did it in 1929 or did it in 1973. Who's heard that and seen that just ad nauseum? And it ends up being wrong because this is not every market is the same. There may be similarities, but often every market has its own peculiarities. The second master key is stock selection. This is the sexy bit. This is the bit I really focus on a lot in most of my training sessions and with most of my software applications that focus on stock selection. Now, when it comes to stock selection, we have what we call, what we do is we follow big money or follow what we call big money footprints. And big money footprints are defined by price level, price action, volume action or aggression, and also something else, which we call scarce information. And scarce information is something I'll talk about a little bit later as well. And there are a couple of others. Now, what we're looking to do here, very simply, is follow what the big money is doing, follow what better researchers are doing, follow what superior analytics are doing. It just makes sense if you can do it. And that's the big capital I and capital F, if you can do it. But obviously, I've spent the last 25 years dedicated to that research, and that's why we serve professional portfolio managers as well. And then the final piece of the puzzle, if you like, the final master key is the trade plan. This is risk control. What's the setup? Does the setup have a good track record? How do you enter? How do you protect your profits once you are in profit? Because most people have allowed good profits to turn into losses. Who's done that? Hands up, everybody. And then how do you follow a trend if a trend manifests? So that's the key to that. So market timing, stock selection, and trade plan. And we apply the same similar principles, whether we're doing discretionary trading or whether we're doing automated quantitative trading as well. Okay, give me a little wave. Let me know that you're here. What I'm going to focus on for now is market timing, because it's one of these things that rarely gets spoken about. But ultimately, what we want to get to is a point where we can time the markets with enough safety to then focus on those big money footprint setups. And the way we really want to do it is to do it in a click. You know, if we can get to these things in a click, how cool would that be? Rather than having to spend hours trying to identify setups. So that's where we want to be. So market timing, we look at short, medium, and long-term indications. And when I say indications, I mean indication, not necessarily indicator. The main thing we want to do is avoid treacherous scenarios, like I just showed, where the market is clearly overbought. And what we do want to do is focus during higher probability times. Again, I repeat, we don't go into conspiracies, we don't have opinions, and we certainly don't do drama. So who's with me on that? No conspiracies, no opinions, and no dramas. We're trying to read what the market's doing. And what I want to say to you guys as well is this. When I look at the market, I see two things. I see buyers and I see sellers. And what my systems are designed to do is to anthropomorphize the market, anthropomorphize the chart. If you're looking at a chart with 12 different indicators on it, or more in some cases, you're going about it the wrong way. What you want to be seeing is clear indications of supply and demand imbalances. And if you can do that, and apply low risk entry setups to it, then you got a chance. And then you got a chance not only of being successful, but being consistently successful as well. Okay, so we look at the evidence. Now, first of all, when it comes to market timing, there is a bit of discretion on it. I'm just going to rattle through my record since the 21st of August. This is all public stuff. You can go onto my blog. I'll show you exactly how to do that a little bit later. You can do it completely free of charge. So in the 21st of August, I was basically just saying things like, look, we could really do with some short-term choppiness. Here's the arrow. That's where we were at that time. I said, look, bullish setups in last week failed to break out. Bearish setups continue to look bearish. Increasing volatility, highly likely over the next few weeks. And we're talking about some bit more volatility, be good for the next down move. Did we get a down move? We did. Go the following week to the 28th of August. Again, the reason I'm doing this is to show you that market timing is possible, and also to give you a bit of confidence that I might just know what I'm doing here. So just bear with me as we go through this, and because who's got market timing wrong in the past, badly wrong, because they had an opinion? Lots of hands going up. Okay, so market outlook that I said on the 28th of August is certainly not bullish, and we did go down. And then I said the next stop will be the 50-day moving average, which was hit, and then closely, the likelihood is we'd breach it, which we did. Now, the following week, 3rd of September, I'm still bearish, and I'm still saying, look, likely to be more volatile once the holidays are over, once the Labor Day holiday is done. I expect continued activity at or below the 50-day moving average with increasing volatility. Well, here's what happened. We got increasing volatility, and then we had these two bars that went above the 50-day moving average. So then I say, well, we got volatility, direction, not quite. But that didn't last, because I said, look, guys, stay the course, because we typically get it right, and my method has no confirmation bias. I'm not looking to try and justify something. I'm just reading the signals that I get as they are. I'm not trying to impose some opinion on it. And I said increasing volatility, highly likely over the next few weeks. And I can see a waterfall bearish setup in its middle phases. What a waterfall setup is: market goes down, goes up, and then does a waterfall like that. Did we do that? Did we get that? Well, that's exactly what we did get right here. It waterfalled down. So we get to the 18th of September, and I say, well, look, my target now for SPY, the S&P, is 374. That is down here. So for a little while, if we slide through that, then the likelihood is hitting or even breaking down through the June lows. The June lows are kind of around this sort of area, or actually sort of this sort of area. So did that actually happen? Well, it did. So then we get to 24th of September, and I'm saying, look, this week I expect a slowdown in the rate of fall, and maybe even a pause or a retracement. We got that sideways move, didn't we? We're more oversold, and the likelihood of pause or retracement is to catch breath is high. So here we are, oversold. We're likely to catch breath. I said it again the following week. We trickled sideways a little bit down, but I said, look, 350 is likely to get hit in due course. Again, we're even more oversold. Therefore, the likelihood of another pause or retracement to catch breath is high. What did we get? We got that retracement, and we did catch breath. We retraced. Then the following week, 8th of October, I'm saying we did retrace before 350 was hit. The likelihood of it being hit remains very strong. Well, this is 350 right here, okay? And what happened next was we hit it. But before we get to that, let me just say, while we remain oversold, the new lows are more likely to occur before the next upward retracement. So what actually happened was this. Oops, sorry. Now I've really screwed it up. Here we go. I think I've gone a bit too far. There we go. So at this point there, love live presentations, things can go wrong. So at this point here, I'm saying, look, we're going to hit, it looks like we'll hit the 350 before the next upward retracement. And that's exactly what happened. We hit 350 and then we started to move up. And that's when I'm saying, look, guys, I think now we're going to go up. Regardless of what happens at earnings, we're likely to break to new lows in due course. So doing earnings, what I'm saying is that earnings is going to go up, and now we're in that retracement. So we are now in this upward retracement, okay? That's what I'm saying at that green arrow. Then we go up a little bit more, and I go in due course means that new lows are unlikely to happen this week. It didn't happen this week. And I said we are in an upward retracement, and that is still the case. We're still in that upward retracement, and that did continue. Then we get to 29th of October, we're almost there, guys. And we go, look, we're getting some resistance around here. We're still, though, in an upward retracement. Go forward another week, 6th of November. And I'm saying, look, a bit of friction around here is likely because of all the resistance around here. Medium-term outlook continues to be volatility. Look at the gapping that we're getting there, lots of volatility, but we've still got a positive bias. And we certainly will get more positive bias if there's a positive follow-through from that Friday. We did get that. So we're getting very close to today now, 13th of November. This was last Sunday. And I say, look, there's still just a little bit more juice in this up move, but we've got a lot of resistance around this area from previous highs and obviously other key levels as well. And I'll come on to what I think is going to happen next in just a minute. What I want to do now is show you the way I look at things so that you can see what I'm looking at. And what you'll find is I'm not looking at any news events. I'm not looking at the Fed. I'm not looking at interest rates. I'm not looking at inflation. I'm just looking at supply demand factors. And that's going to tell me an awful lot, because if you look at these arrows, we did a pretty good job. And that goes back, months and years as well. So I see that we're at the 200 or near the 200-day moving average for the S&P. That will provide some friction. The Dow is at its August high. The Qs are kind of in no man's land. And the Russell is right on its 200-day and the September highs. There's an awful lot of reason to think there might be a bit of friction in this area here. And then I talk about using our trade plan. But I'll come back onto this in a minute. Let's have a look a little bit more about the kind of tools that I have available to me to see. Well, first of all, I look at price, and we can see there's just a bunch of resistance in this neck of the woods. So it's going to provide some friction, or likely. Now, I then have this thing called my options volatility indicator. I'll look at that. I'll show you that in a minute. That's just turned a bit blue. So the likelihood here is there's a little bit more juice here. We're likely to start touching that area in due course, unless something goes completely crazy in Poland and in Ukraine. And then I have what's called the medium-term timer. This medium-term timer is currently, and has been, literally since middle of September, literally right here, positive and not oversold. That's what this means. It's in positive territory, but it's not in the orange area or the yellow area. It's not oversold. And that's correlated really nicely with this move. Again, this is all stuff that's out there and available. Then I have a longer term market timer. My longer term market timer is actually orange right now. So it's kind of amber. And I'm not going to go into detail on this one, but I have these indicators. Three components of it are what builds up this indication here. This says green, but it's actually amber. I actually had a little dot here to say amber, but two of them are still negative. So we're kind of like, you know, in kind of an amber light, not a green light at the moment, long term. Now, a couple of other things I look at, which are very, very cool, again, proprietary to what I do. I look at this thing, which I call the options volatility indicator, shows me what option sentiment is in the markets, what the higher risk players are doing. And I look into this and I go, well, where are we? And I wanted to show you something. In here, I have a pie, and it shows you today that there are lots of bullish stocks in terms of the OVI moving average. And what we're looking at here is in the top 1,000 stocks, which ones have either a negative 5-day moving average for the OVI, or which ones have a positive average in the top 1,000. And what we see here is something very interesting. First of all, when it peaks green, it often coincides with market peaks, as it did last December, as it did in April, as it did in May, June, as it did the opposite way in mid-June, so that's May, that's June, and as it did not quite in July, but did afterwards, so it did a false run there, but pretty much did it again in September, and now we get this, and that's a falsie. We didn't get a market high there. It almost did. I mean, it almost had a little bit here, and then we went down, but then they had the inflation report, and then the markets jumped. But let me tell you, the way I see this at the moment, and we don't get it wrong very often, the way I see it is that there's a little bit more upside potentially, but not an awful lot more. Okay, give me a wave if that makes sense. A bit more upside, but not a lot more from this particular indicator. And what I'm doing here, guys, is I'm building a picture. This is what I do from week to week, and this is how my crew often get it more right than wrong. So let's now look at another pie that I use, those stocks that have crossed and held their 200-day moving averages in the last 30-odd days. So we're looking for stocks that have crossed down through the 200 or up through the 200 in the last and stayed there. But also with my options volatility indicator also being positive for the upside and negative for the downside. So again, I'm looking at demand supply influences and some sort of what you call mean reversion as well. And right now you see big fat green pie with lots of bullishness. Well, let's have a look at what happens. So back in December last year, we hit a peak of these green bars, and that was the starting gun for the bear market. We did it again in April, and that was the peak. It happened again in August. That happened to be a peak. Now, right now, we also happened a big peak inversely in September, bit of a delayed reaction. The market started to recover. And then we kind of got it there. Wasn't quite enough, but we've now got it here. And again, I say to you that the indications are of a mean reversion in due course. So not too far away, probably coinciding with now earnings are over, probably coinciding with other friction that we see around the market in terms of price. Give me a wave if that makes sense so far. So again, I'm building a picture here, and I'm not trying to put any kind of opinion on this. These are all just my proprietary tools. This is how I do things. One more, and then we'll get into what I think is going to happen. I look at the sentiment of what goes on before earnings. I have some pre-earnings strategies. So again, OVI is part of it. I'll show you what that is in a minute, and correlation we do for high quality stocks. And we're just looking at what the sentiment was in the lead up to earnings. And the bars represent how many stocks were positive in the lead up. Now, if you go back to January earnings season here, these bars look quite low compared to the ones that followed. And you see the S&P, well, it's on its way down. And the same thing happened again in April. This peak is much higher, but still not nearly as high as what happened in July, in the July earnings season. And that was peak, which was actually in the middle of a nice ramp up in the markets. This one we've just had, the October earnings season, was so far so good in terms of price action, but very disappointing in terms of the anticipated bullishness in the market, and gives me another reason to think that maybe this move that we've got in the S&P right now may be coming to a halt in due course, because there wasn't the appetite in earnings for this, and this often, again, doesn't get it wrong very often. Then just pure technical kind of stuff, friction in the area in terms of price and also levels, but also just a silly little line like this, joining up the tops, suggesting that this is the area of resistance, whether it's the 200-day moving average, whether it's that straight line, whether it's being a little bit overbought or other things. So that builds me a picture. And I think, you know what? I think as we sit right now, we're in this upward retracement, but I do think what will happen in due course is that we'll head down. I also think at this point in time that the October lows will be tested as well. So in the next little while, I think we'll see the market start to wobble, maybe a bit of increased volatility again. We already see that the Dow is overbought. We see that the Russell and the Qs, well, the Russell is definitely at a resistant level, and so is the S&P as well. I think maybe a touch more upside before a likely drop in the markets, run out of steam. And that's what I think is going to happen. Beyond that, what I think will happen is that trading conditions will start to improve into the new year in terms of being easier to trade. So that gives you an idea of where I think the markets are going. By the way, if you want to look at anything I've got or look at the way that we do it in terms of the 3 master keys, go to ovi.to/free trial. So next, we've done market timing, and I've shown you what I do, and I don't take very long doing it. It takes me 5-10 minutes just to go through these little indicators and just form a view, not an opinion, just a view. So now we go into the stock selection side of things. This is the bit that everyone gets very excited about because it's the sexy bit. How do you select a stock which is primed to do something? And again, for here, we have what we call the big money footprints. Our entire philosophy is being able to follow what big money is doing, because what big money has is big research budgets, big information budgets. They know the right people, they know the right information as well. So let's have a look at this. Before you embark on any kind of strategy for trading anything, it doesn't matter whether it's stocks, stock options, options on stocks, anything else. I only do options and stocks. That's all I do. And by the way, I would definitely advise you to specialize. First of all, you've got to look at the strategy. What are you actually trying to achieve by that strategy? What does the setup actually mean? So, a lot of people make a big thing about flags and consolidations. I do too. But actually, there's not an awful lot of magic in them. It's just a risk control situation. So much technical analysis that you will find out there, unfortunately, is very, very, doesn't pass the test of empirical substance. So what is the strategy? What are we trying to achieve from that strategy, from a risk perspective and from a direction perspective as well? Now, why is that piece of analysis important? So I'm going to show you something in a minute of why what we call key levels can be really important. Why other indicators I use can be important from a logic perspective, not just because someone's done some whizzy moving average on something or complex kind of indicator. There's got to be a story behind it in terms of what does it actually mean. Give me a wave if that makes sense, by the way. It's got to mean something. Otherwise, it's just a pretty little line on a on a chart, which really doesn't mean anything. And you have to back up the logic in this. You have to back up the logic from that anthropomorphized thing. What's going on with buyers? What's going on with sellers? Can you explain it to someone who doesn't understand a chart? If you can't, you probably haven't got anything. If you can, you might be onto something. So the big money footprints is what we do. We follow big money. And what this is all about is that elite investors, the big ones, they trade with billions of dollars every single day. And their activity in certain respects can leave a trail that is completely invisible to the untrained eye. You are totally unaware of what is going on. However, if you can identify that trail, then you get insights. And with those insights, you'll raise your consistency. You'll be able to focus on a particular way of doing things, which will save you enormous amounts of time and also eliminate overwhelm. You can specialize and be much better than you would otherwise have been. Now, when it comes to looking at a strategy as well, you want to know what your settings are. So, what is it precisely that you're looking at in terms of what you're doing? For us, we have this thing called OVI. I'll show you that in a minute. We also look at the specifics in the chart, not too much. And also, is news possibly going to impact my strategy? Does it form part of my strategy? Or do we just want to avoid it entirely? And then, with all that, you want to find these things easily. I mean, if you can't find what you're looking for easily, then the chances are you're not going to last and have a big, decent trading career. So with everything we do, whether, with all that background and foundation work, you still ultimately need something to make it easy for you. It's got to be easy to understand, but it's also got to be easy to do. Otherwise, you just run out of interest very quickly. So let's get into these big money footprints. Big money footprint number one is the presence of big money. Well, that doesn't give much away, but we do that in terms of volume. I'll show you what I mean in a minute. The second big money footprint is all about what we call aggression. Now, this is where prices have already moved. Don't worry about missing out on the first move. That's okay. Often after a first move, you get a second move, and then sometimes you get a third and a fourth as well. So I already want to see that a price can already move. I'll show you that in a minute. Then we have what's called key levels. This is all about eyeballs. I'll show you that. And then also scarce information. So an awful lot of what I do is based around scarce information that I and only a few others have. Very important. So big money footprint number one, big money. Well, what do we mean by that? Well, we mean recent volume acceleration. And the crudest way you can even explain it is imagine that the price is going up, and it's going up in a way where volume is also ramping up. And you've got these green bars going because price is going up and also volume is going up. Now, what that means, and I have a bit of time, I can explain the logic of it. Now, the share float will not change, no matter how much volume is traded. The share float will be the same. So people looking at the share float, looking in the wrong place. But imagine that price is being reasonably positive, and there's these big volume acceleration, emphasized by big bars like that. The share float's the same, but in reality, this could be a sign of accumulation. Now, if it is a sign of accumulation, then de facto, there are fewer shares out there being traded. So supply down a little bit. Give me a wave that makes sense. Although the share float and every other indicator says no imbalance, actually, this could be the start of a bit of imbalance, which means if more shares are being held and not for trading by people, and then more shares want to be traded by other people, then there's fewer in the pot. You can't measure it. No one can say it's there, but this is a little indicator that could be suggesting that. Now, the opposite is true when volume's going down. I've lost my pen here. There it is. What happened there? I don't know. Let's get rid of that. No, I don't want to discard that ink. Here we go. Let's go back. Now, the opposite is true here with when you have share price going down with big volume as well. Because what's happening here is that there's a flood of shares going onto the market. There's lots of supply, which the market makers have to basically mop up. So price going down, big volume, lots of excess supply. Now, the share float hasn't changed, but you can potentially be looking at a supply imbalance there, which can often help price go down even further. Loads of examples of this. So let's have a look at big money in action in terms of volume. Here's Sarepta not long ago. And what you can see very clearly is the first big money footprint. There's all these lovely big volume spikes. in there as well. Lots of accelerated volume in there. Give me a wave if you can see that, by the way. Can you see the nice big volume size? Especially this one, just even this one here. That's the starting gun, and there's another one here. Just give me a wave. Very simple concept, but in the right context, very powerful. So recent volume acceleration, recent. And that was the beginning of a move that was 49% in just 7 weeks. The second big money footprint is recent price surge. So the stock price rises in a pretty big way. Don't worry, goes sideways, and then there might be more to come in the right circumstances. Now, this can often be a consolidation phase, a pause, a flag, that kind of thing. But let's have a look at it in action. And I'll tell you why it's important. When a price surges, particularly after a news event like earnings, what happens is eyeballs are on it. And people go, hey, Bob, what happened here? Look at that big move. Maybe we need to have a piece of this as well. That's what's happening. So more focused attention on a particular stock at a particular time, potentially after a particular piece of news is out or event. And now there's more energy and there's potentially more imbalance of demand against supply on the way up, supply against demand on the way down. Again, look at the logic. If you can't explain it with logic, chances are you haven't got anything that will be consistent. So if we look at Sarepta in this situation, well, look, we've had a big move from 63 up to 77 in only a few days. Just give me a wave if you see that. That is a big move, is it not? Give me a wave on that one. There's your big move. We already know about big money footprint number one, but there's your big move there. And so it's contributing to an overall picture that we see here with Sarepta. And when you see enough of these, you're just going to go, goodness me, I see it now so easily. And up it goes. Big money footprint number three is also about eyeballs. And it's a really terribly simple concept here. Paul Tudor Jones, famous hedge fund manager, made sort of quite an off-the-cuff comment, but it captured everyone's imagination. He said he wouldn't buy a stock unless it was above its 200-day moving average. And so the 200-day moving average became very famous because of Paul Tudor Jones's comment. And it's what we call a key level, because guess what? All trading desks, professional and amateur, have got the 200-day moving average on. Who's got the 200-day moving average on their charts? By the way, who's got that? Many, many people, professionals as well. And so what happens is we're looking to see where eyeballs are looking, because where there's eyeballs looking, there's potential for changes in supply and demand again. So we look for a cross, and then we look for it to stay above it as well. It's not just enough to cross it one way or the other. It's got to cross and hold. And by the way, this can apply to 50-day moving average, also the 20 in high momentum markets. So let's have a look at Sarepta as well. It crosses and holds its 50-day key level in this particular case. So 50-day key level. By the way, I've highlighted earnings as well. Earnings is a key thing as well. Very important to understand that. But anyway, there you've done that. So you've got the third big money footprint there. And again, it's the starting gun of a big move. Now, what you can obviously see here, and I should have put the thing together, is you've actually got one big money footprint here with the big volume, accelerating volume, two big money footprint here, the cross and hold of the key, the big move, and you've got three, the cross and hold. So you're building this picture of potential strength. Just give me a wave, it just makes logical sense. That's all I'm looking for. Just appreciate the logic here. No crazy stuff. The art is how to find it, but there is more. Now, big money footprint number four is the special one. It's scarce information. Now, let me talk to you about what scarce information means and why it can lead to repeatable profits, because repeatable is your secret here. If you don't have anything that's repeatable, you don't have anything. What we want here in trading is a business in a box where we have the chance of making repeatable profits with something that has higher probabilities and strict risk control. So think of the diamond dealer. Now, a diamond dealer typically makes a 100 to 200% markup on the diamond. Why? Well, they've been to diamond school. They have scarce information. The scarce information that a diamond dealer has is they know more about the cut, the clarity, the color, the carat, the source of the diamond in such a way that they have an advantage over us, the retail punter. Makes sense. That's how they make their business. And they're able to make a clip on that basis of that scarce information. And they can do it over and over and over again. In other words, repeatability. Now, an even better example of that would be Coca-Cola, wouldn't it? What's Coca-Cola's scarce information? It's its secret formula that no one else knows about in that big vault in Atlanta. It's worth billions. Their scarce information is repeatable and worth billions. The same concept with KFC's secret recipe. No one knows what that is. It's obviously been marketed well, but that secret recipe that no one can quite do is worth billions. It's repeatable, scarce information leading to repeatable profits. And that's what we want to aim at as well in the stock market. Can we have any scarce information that we can use and deploy to create a repeatable and proven strategy? That's what Wise Traders is all about. That's what I've literally my entire career is all about. So to that end, I created an indicator. It took about 20 years to do, but let's go into it. The Options Volatility Indicator, or OVI for short. Now, all it is, or the way it's displayed, is a line that has a minimum of -1 and a maximum of +1. When it's in positive territory, it's correlating with bullish sentiment, and in negative territory, we hope it's correlating with bearish sentiment. That simple. It's a simple line that's measuring what options traders are doing. And here's what it uses. It uses options pricing and transaction data to bake this cake. And you do not have to trade options in order to use the OVI successfully. So you can use options if you want, but you don't have to. Now, what does the OVI do? What's its substance? Well, the OVI is also driving automated professional systems, real money. So let me show you kind of what it's done. I'm going to show you the second chart first. So this is up to just the other day, November the 7th. And obviously nothing much has changed since that time. But here's us in blue. This is my portfolio in blue. I say my portfolio, our professional portfolio, real money in blue, and the S&P in red. And this portfolio is designed to do one thing and one thing only, beat the S&P. And this obviously is doing it. Since we launched it on the 18th of February, 2020, my system with real money is at 72.17%, unleveraged, just pure stocks. The S&P is at 16.76%. So in the last 2.7 years, almost 2.75 years, the OVI professional automated system is beating the S&P by 330%. Real actualized performance. Nothing anyone can do or say about it. It's there, black and white in trading system. We can just demonstrate that any which way. Now, if you go back in time before, this is, by the way, this is the COVID thing where everything went down. So if you go back before then and go all the way back and test on the same parameters, which we'd obviously done to get to that point in the first place, then the outperformance is 12.7x against the S&P. The S&P is here, and the OVI system, automated again, is up here. So I just want to show you the substance behind this piece of scarce information, because that's what the OVI is. The OVI is scarce information. Now, why is it scarce information? Because again, we've always got to have proof. We've always got to have logic behind it. Well, it's scarce information for two very important reasons. Number one, it's got a patent. So it means that no one else can actually duplicate it or replicate it or display it. So that's a pretty good indicator of scarce information. The other thing is that our number in Wise Traders amounts to very few. Now, if you think there are, I don't know, tens of millions of traders out there in the markets, and by the way, the US market is a global market, and there's only hundreds of us, hundreds amongst millions. So think of that. How few people have access to this scarce information? Very few. And so infinitesimally small. That's why the OVI is scarce information that actually has substance behind it as well, which we can see in the automation, in the automated portfolios. And so we're not talking about 3 big money footprints. We're actually talking about 4 big money footprints. Let's just go through them again so we remember them. We have the accelerating volume. We have the accelerating price. We have the cross and hold of a key level, but staring you in the face has also been the OVI being positive as well. Here and here, even pre-earnings and even post earnings as well. Look, all there. That builds up a picture of more demand and more appreciation for a stock and more likelihood that it's going to go up. Now, just give me a wave if that makes sense, because it's super important that you see we've built the picture, a bit like we did with market time, but we've built this picture. We've built the scenario here, and that's why this stock went up big time. And I could show you dozens and dozens and dozens of examples. Now we've got a little bit more to do because I'm really just opening up my entire system to you here to show you the logic of what we do, why we do it, and why we can remain focused and save so much time. The next part of the Wise Trader system, we've done market time, we've done stock selection. Now with stock selection, there are a couple of other bits to it. One is consolidations for risk control, which we do in the trade plan, and also this other concept of shrinking retracements, which I just want to show you very quickly actually before we go on to the next bit. If you look at the Sarepta chart, just look at this. I'm going to just do that here again. Okay, look at this. See this down move here? That's down move number 1, down move number 2, and then down move number 3. Now, each one of these, and even this one here, is getting smaller and smaller and smaller. Just give me a wave if you see that. So it's not something we can actually filter for, but this is super important. Thanks, Ralph. Super important to understand. In amongst this wonderful picture of big money footprints is something else. Each down move is losing force. It's losing power. Now, sometimes this manifests as a sort of inverse head and shoulders, but forget that. It's not an inverse head and shoulders. It's shrinking retracement. And it's part of the setup. It's part of the picture that we're building. Just give me a wave if that makes sense. Again, everything we do is based in logic and based on what we see. And this is how we anthropomorphize a chart, like no one else does. But obviously, the secret sauce, the real secret sauce, is this here. That makes all the difference. That skews the probabilities. And we know that because that's the only driver of our automated portfolios. So we know that the mathematics of this is obviously very powerful. So let's now go into the trade plan, because this is where you manage your risk. Now I have what we call a game-changing trade plan. But again, with any strategy, you've got to know what it's doing, what the setup is, what the logic is, all that. But what's the steps? Well, the first step is the setup. So for us, we look at specific setups. Often they're sideways moves and consolidations. Then once the setup is right and you've got your big money footprints and all those, then it's like, what mechanism do you use to enter so that you remain in control of the trade from start to finish? So entry, there's a specific protocol for that. Then once you are in profit, by the way, if you go to loss, then obviously you get stopped out, no problem. But once you're in profit, what do you do then? Because most losses come after people have actually been in profit for it and actually sacrificed or allowed a good profit to turn into a loss. Who here, hands up, has allowed a good profit to turn into a loss? Every hand's got to go up with that one. We've all done it. So we need a mechanism to make sure that we don't do it anymore. So we have a mechanism to protect or defend profits. And then what happens if a stock goes on a trend? Who's missed out on a stock trend? All of us. Put your hands up there. Rao is doing a great job there. You're putting your hand up every time. But here's the point. You missed out because you didn't have a mechanism to join the trend or to keep on with the trend as it was manifesting. And the truth is, you never know if a trend is going to manifest. So the first thing you got to do is defend the profit you do get at an earliest opportunity. And then if it keeps on going, you need a mechanism to keep on going with it. And obviously we have that mechanism of risk control, but also exploitation where we can. So the game trading trade plan kind of looks a bit like this. First of all, we need to have evidence of a profitable, logical, tested setup. This kind of thing is such a setup with those big money footprints and other factors involved. So we've got all that in the bag on that one. So the next step is once we're looking at a setup and we can find that setup easily, what do we then have to do? Well, the first thing is we have to do, by the way, there's our setup, by the way. So you've got your big money footprints all lined up there, and you've got your shrinking retracements, et cetera, et cetera. So the second piece is all about control. How do we do that? Well, what we do at Wise Traders, what we do is we only trade after breakouts from sideways move. We have to have a breakout from a clean breakout from a sideways move. So that puts you in control. And then obviously once you've done that, you would be putting in a stop loss at an appropriate point in time, and you'd be setting your profits up at an appropriate level as well. I won't go into the details of that, but the entry piece of this, the mechanics, is putting you in control. So the next step after that is how to defend a profit. Well, the way we do it is we secure profits early. Now, so many people out there going, oh, I'll only make a trade if there's a 4-to-1 win ratio. And I go, based on what? Because it just doesn't actually compute or make sense. The best way to defend a profit is to defend it early. It's just pure probabilities. So if this situation here, you've had a move here, and you've now got to say, where do I take my profit? Well, just do something where your profit could be a 1-for-1 for where your stop loss is. So if your stop loss is the other side of the 50-day moving average, don't be too ambitious here. Don't be too ambitious. Put it about the same distance. So it's 1-for-1, okay? Now that means, and people go, oh, but if 1-for-1, I've got to have a winning track record. Yes, you do. But what if the stock then keeps going? Then you're making more than 1-for-1 if it keeps going, potentially. So there's always the potential for that to happen. Won't happen every time, but at least you've got that. So make sure that your profit target is not too far away. It's ridiculous to try and go for 4-to-1 risk reward ratios. It's absurd. It just doesn't make any sense. And then finally, it's if this stock keeps on going, how do I keep going with it? Well, once we get to that first profit target, or we call it P1, then you need a mechanism. So you've raised your stop to a point that's below where you're at right now. And then if it does continue to go up, then you can shadow that with a simple stepping line. That's pretty much our trade plan. Now, there are some specific rules in there, but that's the entire game plan: market timing, stock selection, trade plan. And the trade plan is this, what we call the edge trade plan, the evidence that it works, the setup, entry, defending the profits, and growing for windfall as well. And that is an entire system in here, which obviously is important. Now, what we can do right now, again, go to ovi.to/free trial. You'll get a free trial of what we do. No hassle, no pressure. See what we do. If what I've said to you here made sense to you, resonated with you, check it out on the free trial, learn what we do, and learn why people, when they find us, because we're kind of hidden away, but when they find us, they stay for years and years. Now, what we can do, I know, David, I think we've got a bit of time here. I'm going to show you a couple of charts, and we can just see some of the stocks we've been playing around with recently, and you can see big money footprints kind of in action, if you like. So this was Chevron. And by the way, just if you can wave at me, it'd be really cool. Bit of participation. But look at Chevron recently. It's been one of the ones we liked recently. Now, who already sees what we might have been looking at and thinking, that looks pretty familiar stuff right here? Who just give me a wave if you see that. Here you go. There you go. I see the same people putting their hands up. But do you see the beauty of it? Because look at this. Around here, we've got a big move, crossing the whole key levels. OVI's there. Didn't have the volume. That one wasn't there. But you got 3 right there, don't you? Which is pretty good. You've also got, oh, if I look at the chart, 1, 2, and a bit of this is the shrinking retracements action that you can see visually there as well. This is Caesars Las Vegas. This was an interesting one. Recently, we looked to think this was above. If you actually look at a chart here, you'll see that where's the 20-day moving average? It crossed and held that one here. So that was interesting. That was interesting. And even this was all interesting as well. And obviously the direction was up in that one. Now, you might not get a full house of big money footprints, but you'll have enough to make a case for something interesting going on. This was DuPont. Lovely poisoned water that they do. Now, here's the thing with DuPont. This just looked amazing. Just look at it. I mean, it really is our stuff. So you've got a cross and hold of a key level there and there. Now, notwithstanding there's earnings here, But look at what's going on here. Look at all this blue OVI, which follows red OVI when it had been going down. And by the way, this stock correlates really well with this OVI, hence the 5 stars. We can also see the pattern recognition here that all the big money footprints, well, they are in action right now, but they would have been here as well. So all those big money footprints would be on display. And again, right now, as we look at it, by the way, so let's just get real where we are today, we're a bit overbought, aren't we? We've gone all this way up, big move from 50 to 70 very quickly. It's not even a tech stock. This is a bit overbought. I wouldn't be buying it right this second. I'd be waiting for it to rest and seeing if it then forms another setup in due course, because we don't chase. Chasing is not what we do. But of course, here, this was easy. This was easy. So hopefully that's resonating with you and you're beginning to see it there now. Let's have a look at Freeport McMoran. Again, you see the OVI change, and then you see entry potential levels. And even now, there might be something in the future for that one there, but not just yet. Just let it go sideways for a bit. We do let me do General Electric. This is just such a great one here. You've got this kind of thing going on. You've got it going on again. It's been bullish for a little while. Let's see where that 20-day key level is if we want to be doing that. It was here. So obviously this is a hit. This is a hit, and it's continued to go. And look at this beautiful action here. In fact, the OVI even turned before earnings as well. So big money footprints in evidence there. Goldman Sachs, just another example here. Similar kind of situation. Unfortunately, it didn't consolidate for us. If it had consolidated here, this would have been an easy slam dunk there. Again, now a bit overbought. Let's go and have a look at a couple of others while we can. Hewlett Packard, recently, this was the area here, crossing and holding, and then a little bit of a move here. Obviously, the big money footprints, scarce information is there. Let's have a look at JP Morgan. This didn't wait around, unfortunately, but that was your opportunity right there. That was it. Big move up, post earnings, OVI starts to turn, big volume. You see the kind of thing that we look for over and over again. 3M, not the most interesting of stocks, but again, similar kind of thing just recently going up a little bit, just a little bit. Sometimes that's all it takes. Let's have a look at OIH, the ETF, one of the oil ETFs. Again, you can see that's cross and hold that 50. Nice action here, and then it breaks out from a sideways move. Let's do Starbucks. Let's have a look at that one. So different stocks doing different things. Here, post earnings up. That's one of our strategies. And again, a little bit of juice from that. Not overbought at the time. Okay to trade that one. Let's have a look. And these are just ones that I've mentioned. Recently, I thought that this was interesting as well. We didn't quite get the sideways move, but this looked pretty interesting to me in terms of the SOXL, the semiconductor ETF. State Street, let's have a look at that one. These are just some random ones here. A bit ragged, but you see what happened there, and it did bounce up, and et cetera, et cetera. Walgreens Boots Alliance. Now, these market conditions haven't been ideal, but even with these market conditions, we can see over and over again the same setup producing great potential trades. Look, from here to here, and even now, maybe, just maybe, we just need a bit more action. Let's see whether it's going to go up further from there. It just needs to rest a little bit. But what I'm hoping we've done here is shown you a system that is repeatable, shown you something that's based in logic, shown you something that actually has some evidence behind it as well, and shown you something where you don't have to get overwhelmed once you learn this system, once you learn how to do it. And by the way, finding these trades is dead simple. All I do is I go into a little piece of software that I have, and literally I just click on a button. I go, okay, find me some big money footprint stocks. So I click on this. This is a magnifying glass. I do that, and then I say, okay, let's look at the charts. And that's all I do. And then I whiz through the charts. I know exactly what I'm looking at because I'm trained to know exactly what I'm looking for here. Chart will pop up in a second. Let's just do that in a second. And then once I do, then a little bit of a glitch there. That's nice. But anyway, once I do, I can go into this. Let's just have a look at this one. I've got a dog barking in the background there, by the way. I can go into here, and then I can actually go in and see which ones I like and which ones I don't. It's really that simple. I press one button, and that's all I need to do. Let's go back in, because I know we're really, really right on the nail with time. but any questions that you might have. And let me just see if I can see something in the chat here as well. Anything that you might have here. So obi.to/free trial. I'm here to answer any questions you might have. I don't know if I can see them. Actually, David, if there are questions, let me know. I can't see whether there are. Will this apply to day trading stocks? Good question. I'm not an intraday trader myself. However, for positioning, yes, you can certainly look at this as your sort of broad, your sort of longer time scale, because we're doing this on daily charts. We don't. We need the information at the end of the day to create the indicator. But yeah, you can use that and go, right, this stock is a ripe one for a bullish move, and then you can take your intraday move from there. So you can use it to sort of govern direction, likely direction on a stock. Anything else? I might just, while we're here, I've got a barking dog who wants to come in. Give me 1 second. He's too quick for me. He ran underneath the desk very quickly. Otherwise, I'd show it to you. Very cute dog, by the way. But any others? Yeah, you got that. That was a number, not a name. I can't see your name there. Anyone else? So again, I just want to emphasize any trading system, because I think we're kind of right at the time where David's going to take over. Any system you look at, it's got to be based in logic. If it's not, then you don't have anything. You need something that's based in logic, because that's the only chance it's got to be a repeatable system. It should cover timing. It should cover stock selection if you're doing stocks. It should also 100% have risk control as part of your trading plan as well. If you are looking at complicated charts with dozens of indicators on it, I promise you're probably going the wrong way. If you can look at a chart and say, buyers or sellers seem to have the upper hand here, or I just can't tell, in which case I'm going to move on to the other chart, that's when you're on the right track as well. Profit taking